What's up, everybody? It's your boy Dave P with RJ Pepino. We are the Cream Cash Flow Real Estate and Money. Today we are talking about the markets are imploding everywhere. The Fed has raised the interest rates. The markets are freaking out. And we are talking about how this is affecting our investment decisions. And actually, quite honestly, why we don't actually care that the markets are tanking. The stock market's tanking right now. Crypto markets are tanking right now. But we feel very good about the purchases and investments that we've made. And we're going to be talking about how we are going to ride out this market for the next several years. I mean, things happen very slowly when there's these major changes like interest rate hikes and whatnot. So with that being said, RJ, how are we feeling today?
Well, the vibe's alive, but check out the new studio. You guys see this new studio? Thank you, Mission Designs, the staging company, Amanda Williams. We appreciate you taking the time to make this new studio pop. If you guys are ever in the Easton area, come in and say hi. We're probably in here shooting some content at the Cohatch. But yeah, I was looking at something today about they're raising the interest rates again. And that's probably going to happen within the next week or so. But an interesting report came out, and that was a CPI report. You like that? You saw the report today. So what are your thoughts on the CPI and what's it related to our real estate market?
So the CPI is coming in hot, right? And what that means, it's coming in high month over month. And it's really funny, like, you know, we're not a political show, we're investors. You know, we are all about making money, hence the cream, cash flow, real estate, and money. We're not political, but it just blows my mind and baffles me how much these politicians, and especially the Federal Reserve, the central bank of the United States, how much they lie to the American people. When this all first started in in COVID and whatnot, they printed trillions and trillions of dollars, I think $6 trillion with the U.S. CARES Act. And they said, don't worry, there is no inflation. There's no inflation, don't worry about it. And the markets all believed it and everybody believed it. Yeah. Then the CPI started coming in hot and they said, oh, the inflation is transitory. Everybody talked about transitory, meaning temporary, don't worry, it's gonna go away. And then they came out and said, well, you know, don't worry about it. We're retiring the phrase transitory. Yeah, we're retiring the word.
We need to come up with a different phrase.
Yeah,
it's actually,
because it comes in high. The inflation. Okay, first they lied about there not being any inflation. Then they lied about it being transitory. Now the biggest lie that they're sharing is we could raise the interest rates to battle in this inflation. That's how you tame inflation, is you raise interest rates. And what they're lying about right now is, hey, we could raise the interest rates and it's going to be what they're calling a soft landing in the markets. Don't worry, it's a soft landing. Soft landing, has anyone looked at the NASDAQ lately? Has anyone looked at the crypto markets lately? So what we're seeing is, when they are raising the interest rates, all speculative assets, so these high-flying tech companies in the NASDAQ, as well as Bitcoin and in the crypto markets, they're imploding right now because as interest rates go up, people are no longer wanting to speculate. They are wanting value and they're wanting consistency. They're wanting cash flow. They're wanting strong fundamentals. And that is what we apply to our real estate investment business as well.
Yeah, that's why when we buy a property, our initial intent is to see how this will be as a long-term, and we're still bullish on the short-term rentals, but we want to make sure that it passes the sniff test. That's the 1% rule. But it has to cash flow, otherwise we're not going to be buying a property that's going to be negative cash flow, right? No. But this is what rentals, long-term rentals, kind of weather the storm of all this crap that's going on in the market, because you're not buying off speculation, just like a lot of these traders do and these crypto guys do. Look, if you made money in crypto, amazing, great. Good. In stocks, awesome.
Perfect.
But right now, a lot of that shit is down because you're not buying stuff for cash flow. These properties are producing 300, 400. Our Airbnbs are producing a couple thousand a month. So it's going to weather the storm when all these rates are going up right now. And I've also seen the refinances are down.
Massively down. So everybody, when the rates went up, and the rates went up like in the last couple of weeks, and now the Fed is saying they're going to continue to raise it because they have to tame this inflation beast is what they're trying to do. But the refinances, the number of applications of people refinancing has completely fallen off a cliff right now. And that greatly, vastly affects the job market. Think of how many people work in real estate or real estate related jobs that have to do with refinances. You have the processors, you have the title companies, you have the loan officers, you have the mortgage brokers, you have the appraisers that go out there and do the appraisal to get this refinance pushed through. All of these jobs are going to be affected, everybody. So the raising of interest rates, it very much affects the overall economy, affects the job market. And then going back to your point, as far as anything speculative, which is, what is speculation? Speculation is, hey, I'm going to buy this thing because I got some access to some stimulus money, or I got this money laying around because money's flying around everywhere when the interest rates are at zero, and I'm going to buy this thing and I'm going to hope it goes up in price. That's what speculation is. That's what crypto is. That's what a lot of these meme stocks are, right? And the opposite of speculation, which is just hope, buying something and hoping it goes up in price, the opposite of that is what RJ is talking about, which is fundamentals. And we apply that to our real estate business. So when we are buying a property, we're not speculating like, hey, hopefully this thing goes up in price and we can sell it for more than we paid for it, right? When we buy something, if it goes up in price and appreciates, that's just gravy. We bought this property from day one. Number one, we bought it at a massive discount. We're not paying retail for anything. And number two, it has good fundamentals, meaning what we paid for the property and what this property is going to produce creates a positive cash flow, right? So as long as you are continuing your investing efforts based on fundamentals, based on value and not hope. Hope is not an investment strategy. Hope is a stripper's name, ladies and gentlemen. It is not a business model or an investment strategy. Make your decisions based on fundamentals, and that is exactly what we're doing here at the Crane.
And Dave, you had a good point there. You can't buy based on. You have to buy based on a couple of things. You have to have equity in the home.
Yes.
You can't buy over close to retail value at any time, because you need to have like a longer term game plan. I see a lot of people making the mistake where they're like, okay, well, it's going to be an Airbnb, so they're paying retail for it. Like, no. You want to pay still. You still want to have 70, at least 25 to 30% of equity in these deals because of what's going on right now. And what happens when there's not that many people with Airbnb, like, they want to even travel? We might have another pandemic. So then what happens then? You're going to have to rent that out. It still has to cash flow as a long-term rental, as if you were to sell it or to rent it out to somebody that wants to stay there for a year or 2 years. You have to be very conservative right now with what's going on. So I think right now a lot of the operators that are coming in that don't have really good sound fundamentals or good operations, processes, and people, they're going to get caught with their pants down right now.
Here's the rule, and we know this very well. You make your money when you buy, you get paid when you sell, right? You make your money when you buy, you get paid when you sell. So you got to make sure you're underwriting your deals conservatively. That's what RJ's talking about. Make sure you're buying a good deal. When the interest rates are low and everybody's a buyer, that means there's a ton of buyers out there. Newer investors or less conservative investors tend to pay a little bit too much because they're speculating. They're like, hey, I know I can find a buyer for this thing. Those days are gone. And only strong operators who know how to buy good deals, but also, the days of cutting corners, those days are gone. You need to be very strong operationally. Maybe we can talk more on that.
You need to be more efficient, right? You need to have a really good sales team and get better deals right now. It's not like, okay, well, this deal, I'm just going to put it on the MLS. We're going to see the buyer pool slowly start to shorten here, like get smaller. Everyone is banking on the market has changed in the last 3 months, and it's not the same as if it was. I know the rates are still going up. So what we've seen before, because we were in this market in 2009 and 2010, we had to get a little bit more creative with our X strategies. That's why we were heavily selling on the back end, rent to own, owner financing, getting a little bit more creative. I bet you right now, and there's a lot of those. We talked about this yesterday. There's a lot of those adjustable mortgages right now that people that got into those type of loans. Those people are probably affected right now.
They will, if not, they will be. So anyone who used an adjustable rate mortgages 3 to 5 years ago, within the last 3 to 5 years, now that the rates have gone up, these mortgages will adjust when they hit that time frame. When the mortgage is going to adjust, it's adjusting up, obviously. So that could be, where is the opportunity lie for us as real estate investors? Number one, we were talking about this the other day, why not target those sellers? Why not get a list of real estate investors who refinanced, right, in your target area and refied or bought using an investment type of loan from Lima One or Corvest, or you just find the lender, it's all out there, public record, right? Why not target that list? You know their payment's about to adjust. Why not go after and see if you can find a tired landlord or a motivated seller because you know their payment's about to go up. Maybe they want to sell, right?
Yep.
Another thing that when the rise of interest rates, when rates go up, we were talking about this as well, what real estate is affected first? Do you remember this?
It's the luxury market.
Yes, the high-end stuff.
Dollar, like in Ohio, it's $500,000, $600,000, $700,000 because the affordability changes. Your bang for your buck, it went from rates were like 2%, right? So you could afford a $500,000 home.
Way more people could afford a luxury home when the rates are low.
Exactly.
As the rates go up, fewer and fewer people could afford this piece of property.
Because you're going to look at your income, and what your income is going to be able to qualify for isn't going to be the same. So I see a lot of those buyers now having to probably wait out the market. They're not going to, they're probably scared. They don't know there are other options out there for them. So they're probably just going to rent, in my opinion. They're probably going to rent. And
I'm thinking about the house flipper. Somebody bought this property, they fixed it up, and they were counting on reselling it for a profit, and they're counting on selling it for $2 million. Then the rates went up, and it's like, well, your buyer pool just shrunk massively. Hopefully you didn't cut a bunch of corners on this $2 million flip, because guess what? Since the buyer pool of $2 million houses is now smaller, they're going to pick and choose, and they're going to pick the one that the investor or flipper didn't cut corners. And this goes back to having strong operations. The strong operators and people who underwrite their deals effectively with good fundamentals, we're going to ride this market out. We're continuing to buy properties because we're buying conservative investments that produce a positive cash flow, and we're not cutting corners, right? Those who have been cutting corners and people who have been paying too much for properties because they're not underwriting them effectively, could start to feel the burn here in the next coming months and years.
So what do you think, obviously you and I have been talking about buying some really nice watches.
Yes.
A couple Rolexes that are we've been talking about, but then also there's a nice car that I've been trying to get a good deal on. Do you think it's a good time right now to pull the trigger on that, or should we, you think, wait it out? You think that's going to be you think we'll see some more discounts?
So when we enter these times with rising interest rates and less discretionary income sloshing around, the luxury market is the first thing to get hit, and that's for the real estate, but it's also for discretionary purchases like boats, like watches, like jewelry, things like that. So I feel prices will start to come down. In fact, we've already seen it in the used car market over the past 3 months. We've seen prices slowly but surely coming down. That's because as the interest rates go up, less people could walk out of the car lot and get a loan to buy a house. To buy a car. So prices come down. When there's less buyers for these things like watches and boats and cars, the prices naturally will start to come down. So if you're in the market for a nice watch, like RJ and I are, we might consider waiting and watching these prices continue to come down.
So do you think right now, and here's my thought on this, I'm going to ask you if you think it's going to become a buyer's market versus a seller's market it's been. I think it's going to be, I think it's slowly going to turn into a buyer's market because there's going to be more houses sitting because of the rise in interest rates, and it's kind of scaring the buyer sentiment right now, and they're just waiting. They're not pulling the trigger. It's definitely, I think it's going to slow down a little bit. I've been watching some of the listings that were selling fast in that 300 to 400 range in price points, and it would take literally the weekend and it would be sold. And I pulled it up today. I'm watching one of our listing agents, and he's got listings in that, and they're still on the market, and I think right now it's slowing down. What do you think?
So that's a very good point, and yes, there's less buyers for the existing properties that are out there, but what we also have to consider is there's not a big influx of supply hitting the market though either. A lot of the people who have refinanced their home. They're just staying put. And the builders are not building houses like crazy because the building materials are still so high. So the builders are kind of holding back a little bit. So that's what the housing market has going for us, or going for it, is there's still a small supply. But yes, with the interest rates rising, there will be more buyers. And it is going to be a little bit tougher to sell a property. There's less buyers, I'm sorry. So yes, things are going to slow down, but it's not going to be like 2008, right, where everybody's mortgage just adjusted. It's not like that at all. The vast majority of people, home sellers out there, they have a nice, cozy, between 2% and 4% mortgage on their house, 30-year fixed rate. Their payments aren't going up. So a lot of people are staying put right now, and that means there's not going to be a vast supply of people needing to sell. That's what crashes the market, when everybody has to sell at the same time, right? Well, that is going to bring the prices down. We're not going to see that. So I think supply will remain low because builders are not building like crazy, because building materials are extremely high and we're in an inflationary time. And then people are comfortable in their house. If you sell your house right now and you pay off that 3% mortgage, what are you going to do? Go buy a new one and put a 6% mortgage on it? It's just not a good play. Just stay put. Everybody's going to stay put, I think, for several years. But I think for those of us who are house flippers, we need to do a really good job, because there is going to be, the buyers are going to be a little bit more picky, which they could be. If they're going through one of your flips and you didn't do a good job, the request a remedy, you're not going to want to lose that buyer. So you got to do a good job and just can't cut corners in these times.
I also think that the strategy, what we have had back in 10, 11, and 12, the strategy was not to go at like the highest ARV. It was listing properties at maybe just 90 and 80% of value, so that you have that cushion of like, okay, is it going to sell? Are our buyers going to be able to afford it? I think a lot of that's what's going on also. Moving forward, I think that's a good strategy right now. You just ultimately right now you just have to be a little bit more conservative when you're buying real estate.
Absolutely. So if you buy it right, you can afford to leave a little meat on the bone for the buyer. Just be conservative is the biggest lesson. And if you're in the market for something expensive like a boat or a watch or a fancy car, prices are coming down. So it could be a good time over the next couple months to start to put some bids in.
Cool. All right, guys, if you want more content like this, go check out our YouTube channel. It's The Cream Real Estate Investors. Subscribe, leave a comment. It's good for the algorithm. And if you guys have questions over there in the social world outside of YouTube, hit us up. I'm at The Real RJ Pepino on TikTok, at RJ Pepino on IG, and Dave is at The Real Dave P. We'll see you on the next video.
Peace.